As 2026 begins, Latin America, especially Venezuela, faces renewed geopolitical and economic turmoil. Venezuela's crisis is a tangled web of political strife, economic collapse, and international intrigue, drawing in global powers like the US. The instability disrupts daily life, cripples infrastructure, and creates a volatile environment for business and investment. International involvement, including ties to Colombia and Iran, adds further complexity. These developments directly impact global commodity markets, especially crude oil. For investors, understanding this geopolitical chess game is crucial, as the next move could drastically alter asset values tied to the region. The most immediate impact is felt in the energy sector, where oil supply and pricing are tightly linked to Venezuela's fate. Oil is the economic backbone of Venezuela, shaping not just its economy but also its society and politics. For decades, the country has relied on its vast oil reserves to fund public services, infrastructure, and social programs. Oil money once fueled a period of prosperity, making Venezuela one of the wealthiest nations in Latin America. But Venezuela isn't alone. Oil is a major driver for much of Latin America. Countries like Brazil, Mexico, and Colombia also depend heavily on oil exports to power their economies, create jobs, and attract foreign investment. The region's oil industry is a critical link in the global energy supply chain. Yet, Venezuela's dependence on oil has become a double-edged sword. While its reserves once promised endless prosperity, years of mismanagement, corruption, and political turmoil have left the nation vulnerable. Today, much of its oil infrastructure is crumbling, and production has plummeted. Disruptions, whether from political instability, international sanctions, or chronic underinvestment, can quickly ripple through global oil markets. When Venezuela's output drops, the effects are felt far beyond its borders, impacting energy prices and market stability worldwide. A crisis in Venezuela isn't just a local issue, it's a global event. When production falters, oil prices surge, affecting everything from transportation costs to the price of goods around the world. For the US, this means higher costs at the pump for everyday drivers and increased expenses for businesses that rely on fuel. American consumers feel the pinch almost immediately. But there's another side to the story. Higher oil prices also translate into bigger profits for American energy giants like Chevron and ExxonMobil, whose global operations benefit from market volatility. The fate of Venezuela's oil industry is a multi-billion-dollar question mark for investors. Financial analysts and energy companies closely monitor every development, knowing that even small changes in production can shift global markets. If Venezuelan production stays offline, global oil supplies remain tight and prices stay high, benefiting some but straining economies worldwide. But if Venezuela manages to restore its output and flood the market, a sudden supply glut could send prices tumbling, creating new challenges for producers and investors alike. Companies with assets and expertise in the region, like Chevron, are now in the spotlight, navigating both the risks and opportunities that come with Latin America's ever-shifting oil landscape. The ongoing crisis in Latin America has sent shockwaves through global financial markets, with the United States feeling the effects almost immediately. Political unrest and economic uncertainty in key oil-producing countries have created a ripple effect, making investors and analysts alike pay close attention to every development. U.S. markets, especially those tied to the energy sector, have responded with heightened volatility. Traders on Wall Street are reacting swiftly, as news of instability abroad often translates into rapid shifts in stock prices and trading volumes. Reports of potential supply disruptions have sent investors scrambling to adjust their portfolios. Many are moving capital into oil equities, anticipating that reduced output from Latin America will drive crude prices higher in the near term. While the broader S&P 500 and Dow Jones indices have experienced modest gains, it's the energy sector that's truly surging. Energy stocks are outperforming the market, as investors seek out companies poised to benefit from tighter global supply. Venezuela's crippled oil output, a direct result of ongoing turmoil, has removed a significant chunk of supply from the global market. This shortfall has made U.S. oil producers more valuable, as they are now in a position to fill the gap left by declining Latin American exports. Investors are betting that American oil companies will see higher profits as they ramp up production to meet increased demand. Wall Street is abuzz with speculation about which firms will benefit most from the shifting landscape. The CBOE Volatility Index, or VIX, has climbed sharply, reflecting the market's growing unease. This index, often called the fear gauge, signals that investors are bracing for more turbulence ahead as uncertainty persists. In times of uncertainty, investors traditionally flock to tangible assets that hold intrinsic value. Oil, much like gold, is seen as a safe haven during periods of geopolitical instability, making it an attractive option for those seeking to protect their portfolios. U.S. supermajors, such as ExxonMobil and Chevron, are viewed as reliable and secure sources of energy. Their strong balance sheets and global reach make them especially appealing in a volatile market. This flight to safety is fueling a powerful rally in the energy sector, with investors pouring money into companies they believe can weather the storm and capitalize on higher prices. Among these, Chevron stands out as a primary beneficiary thanks to its robust operations and strategic positioning in the global oil market. Chevron has become the focal point for investors seeking exposure to the Latin American oil crisis. With decades of experience in Venezuela, Chevron has unique institutional knowledge and a direct stake in the country's oil future. Despite sanctions, Chevron has maintained a minimal presence, preserving its assets for a potential reopening. If stability returns, Chevron is poised to ramp up production quickly. Investors have noticed, Chevron's stock has surged, outpacing the broader market. Its diversified operations across Latin America and beyond provide a crucial buffer. Chevron offers both a bet on crisis resolution and a hedge through sustained high oil prices. As of January 5, 2026, market data shows investors reacting to geopolitical stress. Crude oil WTI and Brent futures are up, reflecting supply concerns from Latin America. The Dow and S&P 500 are rising, while the Nasdaq lags. Investors are rotating into value and commodity-linked sectors. The VIX is up, signaling caution. Chevron stock stands out with a strong gain and high trading volume. Investors are targeting companies with the best exposure to the crisis, not just the sector as a whole. Even with higher treasury yields, energy stocks like Chevron remain attractive. The market sees Chevron's upside as uniquely compelling in this environment. Chevron's appeal goes beyond being a big oil company. It's about its unique position in Venezuela. While others left, Chevron maintained a foothold through special waivers and patient strategy. If Venezuela reopens, Chevron's existing assets and local knowledge give it a massive head start. Investors see Chevron as an option on the future of Venezuelan oil, a potential multi-billion-dollar prize. The company's strong balance sheet and reliable dividend add a layer of safety. Chevron's global diversification means it profits from high oil prices regardless of Venezuela's outcome. This rare mix of speculative upside and defensive quality is drawing investor attention. Chevron is positioned for both immediate gains and long-term rewards. Comparing Chevron to its rivals highlights its unique edge in the current crisis. ExxonMobil lost its Venezuelan assets years ago, while Chevron kept its operational presence. European majors like Shell and BP are pivoting to renewables, making them less leveraged to oil's immediate upside. Chevron's disciplined capital spending and project management inspire investor confidence. Its strong balance sheet and robust dividend make it a safer bet than peers with more debt or recent dividend cuts. In a nervous market, Chevron's stability and unique geopolitical catalyst stand out. Investors see Chevron as the best blend of security and high potential upside. The opportunity in Venezuela is massive, representing one of the world's largest untapped oil reserves. However, the risks are equally significant. Political instability could persist or even escalate, and the threat of nationalization always looms over foreign companies. The country's volatile environment means that any investment could be jeopardized by sudden policy shifts, economic turmoil, or changes in leadership. For Chevron, navigating this landscape requires a careful balance between ambition and caution. Chevron's strategy is to maintain a minimal, low-cost presence in Venezuela. By keeping operations lean and overheads low, the company preserves its legal standing and keeps a foot in the door without overexposing itself to the country's unpredictable risks. This approach allows Chevron to remain compliant with both local and international regulations, while also signaling to the Venezuelan government that it's willing to engage if and when the environment becomes more favorable. In effect, Chevron treats its Venezuelan assets like a high-upside call option. The company isn't betting the farm, but it's positioned to benefit handsomely if conditions improve. This means that, rather than being a major drag on the company's finances, these assets offer the potential for significant returns with limited downside. Meanwhile, Chevron's global portfolio, especially its robust U.S. Permian Basin assets, ensures the company's financial health remains strong, regardless of what happens in Venezuela. These diversified holdings provide steady cash flow and growth, acting as a financial anchor. The company also benefits from high oil prices, which are often driven higher by crises like Venezuela's. This acts as a natural hedge, allowing Chevron to profit from market volatility even as it waits for a potential breakthrough in Venezuela. If the crisis in Venezuela is ever resolved, Chevron stands ready to unlock even more value from its assets there. The company's patience and strategic positioning could pay off in a big way, turning a long-standing risk into a major opportunity. This heads I win, tails I don't lose much scenario is highly attractive to investors. It means that Chevron can offer upside potential without exposing shareholders to excessive risk, a rare combination in the oil industry. Ultimately, Chevron's ability to profit from uncertainty and manage risk is a hallmark of a well-run supermajor. By staying nimble and strategic, the company continues to thrive, even in the world's most challenging markets. As Latin America's crisis unfolds, Chevron stands out as the top oil stock for investors seeking exposure. Its unique history, strategic positioning, and financial strength set it apart. Chevron benefits from high oil prices now and holds a rare, tangible stake in a potential Venezuelan recovery. The market's reaction, outperformance, and high volume underscores its compelling story. Compared to peers, Chevron's direct catalyst and defensive foundation are unmatched. For investors wanting to position for multiple outcomes in Latin America, Chevron is the logical choice. In 2026, all signs point to Chevron as the premier stock for Latin American oil exposure.